Namaste, welcome to Arthaniti, where we discuss money and money matters to help you in your investing decisions. Gold rates have reached $3,000 mark. It has been a symbol of wealth, power, and security for centuries. Right from ancient civilizations to modern economies, gold has stood the test of times. But why does this yellow metal continue to shine in the world of investments? Today, let us uncover the story behind the meteoric rise of gold and if it deserves a place in your investment portfolio. Firstly, we will visit the prices of gold over the period of 100 years. Now, this chart, which closely aligns with the historical data of gold prices, shows the prices beginning from 1925. Now, if you check the data, the journey of gold is nothing short of extraordinary. In 1925, 10 grams of gold was priced at 18 rupees 75 paise. Fast forward to March 2025, the price of 10 grams of gold have crossed 86,000 rupee mark. If we focus our attention on the previous 3 decades, starting from 1995, so for the decade 95 to 2005, gold prices rose by 50%, which was basically driven by global economic shifts. For the decade 2005 to 2015, gold prices rose at a staggering 276%, basically because of the uncertainties following the financial crisis of 2008 and the rising safe haven demand for this metal. From 2015 to 2025, the last decade saw gold prices rise by 82%. We had a COVID in this decade, and the price rise has to be factored for that pandemic, as well as inflationary pressures and geopolitical risks that we saw in this decade. Here is a second chart that I want to bring to your attention. It is by AG's in Gold We Trust report. Now, what this report basically suggests are the probabilities of gold prices in 2030. Now, it is based on incremental gold pricing model. Some key findings of this chart that you should be aware of is the most probable gold price range in 2030 is between $3,000 to $5,000 per ounce. So we have reached that $3,000 mark in 2025, right? This probability that the gold prices 5 years hence in 2030 would be in the range of 3 to 5,000 has a peak probability at 18.1% for 3 to 4,000 and 18.6% probability for 4 to 5,000. Now, lower probabilities are assigned to extreme price ranges. So, gold going below 1,000 mark is only two. There is only 2% probability to it. Gold going above 12,500. So, extreme uncertainty and extreme rise in gold prices has a probability of only 2.4%. Most moderate probabilities that are shown in this chart, gold between 5 to 6,000 range is at 13.5%, 6 to 7,000 range is at nearly 10%, is at 9.9, 7 to 8,000 6.3. So the highest probability, which is the most possible outcome 5 years hence, goes to a price range of 5 to 6,000 dollar mark, which is double the price gold is at today. Central banks all over the world also seem to love and trust gold. Now, RBI holds nearly 876 tons of gold, which is valued at approximately $71 billion. It was the third largest purchaser of gold in 2024, where it purchased 73 tons of gold. Now, almost 60% of the gold that RBI holds is within the walls in India. Nearly 40% of the gold is held with central banks outside the country. In late 2024, RBI repatriated nearly 200 tons of gold from Bank of England. So basically, central banks all over the world use this metal to stabilize currency and to diversify their reserves. Indian households, typically Indian women, collectively own nearly 24,000 to 25,000 tons of gold. This represents 11% of the global gold reserves. Now, this amount collectively surpasses the gold reserves of the top five countries. Regionally, if you check the concentration of gold within India, southern India accounts for 40% of the gold reserves, within which Tamil Nadu alone contributes 28%. So, we in India have known the value of gold as a reserve for wealth and security for centuries. This third chart shows the relationship of silver prices in comparison to the gold prices. Now, it is a data for the last 50 years, beginning from 1974, and it shows the annual peak spread of silver prices in comparison to the gold prices. The spread peaked in the late 1970s and early 1980s, exceeding 6%, which is likely due to the speculative trading and economic factors during that time. Now, from mid 1980 onwards, the spread stabilized around 2% with occasional spikes to 2.5%, especially in 2011 during heightened market volatility. In 2024, the spread has been at 1.15%, which shows underperformance of silver in comparison to the gold prices. What this suggests is that there is a room for silver prices to rise in comparison to gold prices, as it is below the historical levels. Some factors need to be kept in mind when we are discussing the relationship between silver and gold prices. Firstly, silver prices and gold prices are positively correlated, in the sense when gold prices go up, silver prices tend to follow. But silver is more volatile, it has a high beta, its prices tend to fluctuate more in comparison to gold. Secondly, industrial use of silver. Unlike gold, silver has many uses in the industry, like it is used in electronics, solar panels, electric vehicles, etc. And it can affect the prices of silver independently than with gold. Thirdly, traders use gold silver ratio to assess their relative value. In the sense, when this ratio is high, it indicates underperformance of silver in comparison to gold, and that can lead to more demand in the purchase of silver. Thirdly, economic factors like inflation, interest rates, currency strength affect both these metals. Low interest rate and inflationary pressures tend to boost demand for these precious metals. Geopolitical factors like instability in geopolitical relationships boost demand for safe haven assets like gold and silver. Now, mining supply dynamics. Changes in mining supply impact both these metal prices. A decrease in supply tends to boost prices proportionally more for silver than for gold due to its high volatility. So, should you invest in gold or silver? Well, both metals have their own strength. Gold is a safe haven asset and is typically used as a hedge against inflation. Silver has shown higher volatility but also has higher returns during bull markets. Currently, silver prices are undervalued in comparison to gold prices, which suggests that it could be a buying opportunity for savvy investors. But you should also keep in mind that silver prices tend to be more volatile than gold prices. Now, there are various options through which you can include these metals in your investment portfolio. Firstly, you can hold them in physical form, which we normally do by way of jewelry, coins, right? Silver ware that we use are all the physical gold and silver that we have in our houses. There are various pros and cons to this approach. Pros is that you get a direct ownership of these metals. You hold tangible assets which have intrinsic value, and culturally there is a lot of significance to these precious metals in India. What are the cons? Well, you have to store them, secure them, and most of the times insure them. Thirdly, when you purchase these items, you normally purchase them at premium, but when you go to sell these items, they are normally sold at a discount. and there is limited liquidity. It is not immediately liquidated as is the case with some other financial investments. Correct. Taxation is also one of the angle which you cannot ignore. Now, for any gold or silver which is held for more than 3 years, long term capital gains tax of 20% with indexation is applied. For less than 3 years, short term capital gains tax at your tax slab is applied. A GST is also applicable when you purchase gold or silver items. So this taxation also needs to be taken in taken into consideration. Second option is gold or silver ETFs. ETFs are exchange traded funds. Now, some of the advantages of holding this investment is there is very high liquidity. It is immediately liquidated, lower cost as compared to storing physical precious metals, correct? And it is accessible through brokerage accounts. There is no need for physical handling. But we need to see what we have purchased, correct? We need to hold the metal if we have given money for it. In case of ETFs, it is only paper money, correct? It is subject to management and administration fees of the funds, and counterparty risk of fund managers is also involved. When it comes to taxation, it is similarly taxed as physical gold. Gold and silver mutual funds, unlike passive ETFs, are actively managed, and their investment portfolio includes securities related to these metals as well as mining companies. Now, professional management can help give you better gains than a passive ETF under certain conditions. Correct? It gives you an exposure to mining company stocks as well. But on the flip side, there are higher expense ratios, and the performance of these funds depends on the capabilities of the fund manager. One more option that was available to invest in gold was the sovereign gold bonds. Now, these bonds have a lock in of 8 years and annually give an interest of 2.5%. Interest that you earn on these bonds is taxable as per your tax slab, and capital gains is exempt if you hold the bonds till maturity. Government had recently announced premature redemption of some series of these bonds given the high increase in gold prices. Digital gold is also an option to invest in gold, where you can invest from as low as 1 rupee via app. You don't need to hold a demat account, but what you need to be aware of is the limited legal framework for digital gold apps as compared to your investments in, say, ETFs or gold or silver mutual funds. So, is it worth investing in these metals at current prices? Well, currently, gold is trading above 86,000 mark in India. But as per a previous chart that I shared with you, gold prices are slated with the highest probability to be in the range of somewhere around $5,000 to $6,000 from where they are currently at $3,000. Correct. So that is double the prices. So nearly in the range of 1 lakh 60 to 2 lakh rupees per 10 grams by 2030 is what is the most highly probabilistic prediction. Silver is currently undervalued as compared to gold, correct? I also shared a chart which suggested that historically the spread of silver was at 2%, while currently it is around 1.5. So that gives some scope of price rise when it comes to silver. So this could be an opportunity for you to enter silver, where the prices generally tend to stabilize near the 2% spread. Again, you should keep in mind the high volatility in silver prices as compared to gold prices. How you can start investing in these metals? Firstly, start by allocating a smaller percentage of your portfolio, between 7 to 10% of your portfolio, in precious metals like gold and silver. Opt for ETFs or mutual funds. Why? Because they give you easier liquidity options and a low storage cost. Thirdly, I'm sorry, if you want to hold them for long period, then physical gold is also a very good option to hold. But there are security risks involved and storage costs that you need to consider. Investments in these precious metals help to balance your portfolio and give you the much needed financial security. Gold and silver are not just mere investments, they are your shields against uncertainty and tools of long term wealth creation. Whether you are a seasoned investor or just starting out, these timeless assets deserve a place in your investment portfolio. I hope you have liked this analysis and the video. What have you invested in, gold or silver, and what investment option have you chosen for this investment? Please let me know in the comment section. Please subscribe, share, and like my video for more such interesting, informative content about investing. Until next time, stay safe and goodbye.